Great.
Hey everyone, welcome back to the channel, your number one source for income-oriented investing. First time on the channel, very excited about this. Sai Katara, you are the CEO, the founder, the portfolio manager of Tap Alpha, which currently has a S&P, only one ETF. Correct me if I'm wrong. You only have one ETF for now, but I think there's more coming, and it's called
Mhm.
TSPY. The Tap Alpha SPY, which we know is pretty much the S&P 500 growth and daily income ETF. So, Sai, thanks so much for taking the time. And if you could just introduce yourself to the audience and what you do and what you've been doing since it's your first time here.
Awesome. No, really appreciate you having me and love the work that you do on the channel too. Like we
Appreciate
were
it.
talking a few minutes ago, just the focus on getting in depth and sort of under the cover of ETFs and what people are investing in. And especially now, I've seen a couple of your videos where you're helping provide kind of a steady hand in a very unsteady environment. So I think that's really helpful for your viewers. So I appreciate you having me on.
Appreciate it.
Um, little background about myself. So I actually came from a totally different world. Wasn't originally a finance background. I was a computer engineer by trade. So ended up working for a startup in Silicon Valley. Our startup got bought by a big company called Cisco Systems. And I was lucky enough to have a little bit of capital where I ended up founding my very own software company in 2005. So built and ran that for 17 years, loved it, but like I blinked in my eyes and half my career was already behind me. So I was like, if I'm going to do anything else in my life, I got to make a change now. So in October of 22, I ended up leaving to figure out what the next adventure would be. I had always kind of been a SPY, buy and hold investor, just kind of let it run, and it served me well because I was busy, doing the day job. But when I left, I don't know if you remember, but October of 22, the markets were way down, and I was trying to figure out, hey, how do I make ends meet? And the other thing that was a real challenge, not necessarily perfect timing, but 4 months from that date, we're going to have our first baby. And so I was feeling that financial pressure, feeling the stress. And I didn't want to have to sell SPY shares to make ends meet. So I remember a strategy my dad had taught me, which was covered calls. But the novel thing that happened right then was 0 day covered calls just became available.
Right.
So I was like, all right, let me try it. So I tried it. Fast forward 2 months, just the options premium on top of my SPY shares was covering the lion's share of my family's mortgage. And that was such a huge financial relief, especially, at a time where our baby was coming. Like I didn't miss a thing. My daughter's first year, I missed nothing. And I was completely present because that financial stress was alleviated from kind of doing the strategy. The challenge was if I had a full-time job, I couldn't do it. Like if you're doing calls every day, it is a ton of time. And I'm a kind of a nerd, and so I did a lot of math to figure out like where to place my calls dynamically every day. So it took like 3 to 4 hours every day to manage a
Wow.
strategy. So with the software background, I ended up writing some cloud-based tools that took 3 hours down to under 5 minutes. And I was like, this is it. This is the next business. And was just, it was that feeling of like, if I can share this with other families like mine, I can make a positive dent in the world. But I didn't know the best way to get it to market. I kind of fell back on my software background where I'm like, oh, maybe I'll create a SaaS service where you can log into the web and connect your brokerage account and you can manage it easily through that. But that's got its own hurdles too. And then we were lucky enough to meet some ETF issuers out of New York. And they're like, you should just take this strategy and wrap it inside an ETF and launch it on the NASDAQ. And then everyone can get that value that you're doing, but delivered right to their brokerage account. So that's what we ended up doing. We launched, so we took it, ended up taking a little bit of time because of how we actually built the implementation of the fund. But we launched on August 15th of 2024 and sort of have been up and running ever since. And that's really all it is. It owns dollar for dollar shares of SPY. And then every day we're just selling out of the money covered calls to harvest little bits of option premium. But when you do it with zero dated options, the premiums are fantastic. And so it helps actually create a meaningful income stream for investors that we end up distributing on a
Yeah.
monthly basis
For
for
sure.
investors.
Well, a lot to unpack there, and I want to get to the ETF in a second. We'll talk all about the ETF, the breakdown. You kind of touched upon it, but I just couldn't help smile and listen to your story because it's almost like your life is the epitome of the PII or the passive income investing system. That's what this whole system is designed for, the person it's designed for, and the covered call ETFs are designed for, in my opinion, it's to take away that worry, right? That consistent cash flow takes away that worry. And like you said, you had SPY, you're writing calls yourself, but you were spending 3-4 hours a day on it. So when cover call ETFs take that away, they take that, gives you that time back. And my whole philosophy of investing in this kind of system that I'm not going to say I created, but that I showcase on my channel, that I personally follow, which I basically just own cover call ETFs exclusively and collect the income. You kind of explained it to a T as a real life example using yourself. So I want to say thank you, by the way, because that was awesome. That was fantastic. So now let's talk about this ETF. So we're talking about TSPY. This is a US listed ETF. The stock symbol is TSPY. And like you said, this is the name is TAPPALPHA SPY Growth and Daily Income. So there has been an explosion and popularity explosion of the zero DTE or daily covered calls, which for now, I believe you could only do them on the three major indexes, the S&P, the NASDAQ, and the Russell. I think maybe more to come on that, but for now, it's just on those indexes. So these are covered calls that expire daily, right? There's zero DTE, 0 days to expiry. So, and you talked about the strategy a little bit. I heard a daily out of the money call. So tell me a little bit in detail the day-to-day operation or the strategy of this ETF a little bit further.
The main thing is that it's a true zero DTE strategy, meaning we literally are focused on only writing the option for the 6.5 hours of the trading day. That's a really important differentiator because there's some funds out there that, say zero DTE, but they're actually doing a 24-hour, like a 1 day. And one of the reasons is when the way that you win and lose in options and doing out of the money covered calls is really risk mitigation. And if you can actually be risk off on the covered call overnight, you don't actually have to manage the risk there. You've got your SPY position, which will catch any upswing or downswing overnight. But a lot of times when the markets are closed and it's after hours trading, markets 66% of the time go up. So if you have a call, it's actually really helpful to not actually have an open position overnight. And that's one of the big differentiators between a 0 day strategy and, for example, a standard 30-day strategy.
Right.
Huge benefit for being able to avoid overnight risk and weekend risk. And then the second thing, like when I was figuring out how to implement TSPY, the 0 day strategy compared to a 30-day, there's a huge benefit for the option premiums that are available. So if you're familiar with covered calls, if you just do a standard 30-day strategy and you write a 25 delta out of the money covered call and you collect X in premium, but you swing once for the month. If you did the same thing with 0 days and just traded the 21 days over that period, same risk level the whole time, and you added up those premiums, you get 4 to 4.5 times the option premium essentially for the same risk. So the risk adjusted returns for 0 day calls are way better than if you do a standard 30-day covered call strategy. And that was one of the reasons why we wanted to build a true zero DTE fund.
Okay.
And then the third thing that's really helpful too, especially in markets like we're dealing with right now.
Yeah.
When you do a 30-day strategy, you get one swing, you get one at bat. But 0 day, you get 22 at bats. So you can actually reset your strike every morning, and that gives you a way higher probability that you can track the underlying securities returns over time.
Yeah, I personally absolutely love the daily covered call. There's less timing risk compared to a 30-day call, right? Because if you write that 30-day call and then the market goes up 30 days in a row, you're missing out on a lot of upside. But if you're doing it daily, it resets every day. So I'm looking at the holdings now. So it looks like you based the ETF literally has almost 100% in the SPY. So you're actually holding the SPY. And then there's some cash and cash equivalents here, which is normal in a covered call ETF. You got to have some cash and whatnot for the options. And then here's, I guess, a daily option. So just to recap, every trading day, you guys will write the call. It expires that same day, 6.5 hours, like you said, but you still capture the overnight swings of the S&P 500 because you're still holding the SPY. Is that correct?
Nailed it. That's exactly right.
So you do have overnight exposure because other zero DTE daily covered call ETFs tout this as a huge benefit. You do have overnight exposure to whatever the S&P 500 does, up or down.
Exactly. So the long position, just like you said, dollar for dollar, we own SPY, and so we get that potential movement overnight with
Yeah.
the SPY share. The thing that we
Why?
don't
Yeah.
have is the call. That's all overnight.
Okay. So two questions. Why hold SPY instead of IVV or VOO, which has a smaller management fee, I believe? That's number one. And number two,
Mhm.
a lot of other providers, you can't like competition, or I believe all the competition that does a zero DTE, or most of them, use a synthetic strategy where they will hold either the S&P, the Nasdaq, or the Russell, depending on whatever it is. Synthetically, they don't actually hold. Well, some of them do hold IVV, but some of them do it synthetically. So first question was that one, and then second question, why are you actually holding the SPY and not doing it synthetically to, I guess, save on fees?
Those are great questions. So the first one, why SPY?
Yeah.
We ended up going with SPY to start because when we started the fund, SPY was the most liquid. So we wanted
Ah,
high liquidity to make sure there was no trading risk. But since then, actually, you've seen IVV and VOO overtake SPY because of the reduced fees. So over time, we may optimize, but we wanted to start with SPY for liquidity reasons, and that was the core reason. The second case, yes, the synthetic versus real shares. And I'll tie this back to a story too. So when we were trying to get this to launch, our custodian couldn't actually do like real shares and then write covered calls because they didn't have the infrastructure to collateralize the option position. So they're like, why don't you just do a synthetic? And I was like, I don't want to do a synthetic because how do I, there was several reasons and some really big ones from a tax and end of year perspective. The first one was, how do I explain it to my mom? Hey, mom, you own SPY right now. How are you gonna, if I'm gonna do T-SPY as a SPY replacement?
yeah.
She was like, okay, well, what do I own? And I'm like, well, you own a synthetic option that simulates
Hard to explain, yeah.
the returns of the SPY. And she wouldn't be comfortable with that at all. So I wanted to make sure I was able to meet that investor sort of baseline. And the second thing is when you have a synthetic option underlying, we design this fund to be growth plus income. So we want NAV to grow and we want it to kick off income over time. Well, if you're doing a synthetic because of tax rules and ETF rules, at the end of the year for the underlying synthetic option position, even if you don't realize the gains in the underlying synthetic, you still have to ultimately distribute the capital gains to shareholders because of the ETF rules, 90% or more.
Yeah.
So if I wanted to use the SPY shares as a value store over time to compound capital growth and then have it be long-term capital gains, there's no way for me to do that if I had synthetics as the underlying. And so the
Interesting.
other thing that I realized is that because of that, the NAV growth, there's no way for a synthetic implementation of this strategy to go better than 0% NAV growth year over year. And that was a huge deal breaker for us. And so we fought hard. It took us an extra 5 months to implement the strategy by owning real shares and writing covered calls because of the desire to want to have that benefit. And then there's also some tax implications too, which we can talk about if interested.
Okay, well, that pretty much answers that. So let's take a look at this ETF. You already have, this has been out for about 6 months, a little over 6 months. I know you guys came out with a press release talking about the 6 month milestone. About 31 million in assets, which is a pretty good growth for a more niche covered call ETF that uses daily options, which is still a little bit newer, not as known. Manage expense ratio was 68 basis points, so pretty much in line, and I would say even lower than most zero DTE cover call ETF. So that's a very attractive fee if you ask me. Distribution rate's about 14.5%. And one thing that I've noticed is that the monthly, these are monthly distributions, right? These are not weekly distributions like some of the competition.
Yep.
But they're very, very consistent. They're fairly consistent. So can you tell me a little bit about your distribution policy? Why monthly? Why not weekly? And how the heck are you able to do them so consistent with a zero DTE strategy, which means you're getting different levels of premium every day, essentially.
Yeah, it's one of the things that we learned when putting out a part income, part growth product is that income investors require and want consistency. Whatever your baseline you set it at, like you just got to make sure you're delivering consistently. And so we've been hyper focused on making sure that we are within that 13 to 14% range. And that's one of the reasons why we've been able to do consistent distributions. The distributions have to be paid for in some way. So you kind of hit on it. Markets go up, markets go down, but your distribution is actually steady. So what happens is there's several places where the dollars come from. One, because we own SPY shares, we're able to distribute the SPY dividend every quarter. So that helps fill one of the gaps. Two, we're doing option premium income that fills another gap. And then three, some of the capital appreciation, if there's a hole between what we're able to collect in those first two buckets, we can fill a little bit of the gap with some of the capital appreciation, but we do so in a tax efficient way where we're kind of tax loss harvesting to fill that gap.
Right,
And then if the markets completely tank, for example, well, what's nice about covered calls is you're likely going to get higher option premiums because
right.
you've got more headroom. So that fills some of the gap. And then if you worst case, you have to do some return of capital to get that consistent distribution, you've got all of those tools in front of you to do so. So that's how we end up getting such a consistent distribution, even though each of those pots may fluctuate month over month.
Awesome. So, like most cover call ETFs, can we expect a large majority of the distribution to be classified as rock? Would you say?
Yes, and there's a
Okay.
exactly, and there's a good reason for that too. I didn't know why. So one, there's a potential tax advantage, but some people I'll get questions in from investors and like, wait, are you just returning capital? And what's interesting about ETFs, there's kind of an old rule that if you're only allowed to distribute realized long-term capital gains, I think twice or maybe three times a year. So
Okay.
you'll never know what your realized long-term capital gain is going to be until the end of your fiscal year. So the only safe way to do it in some cases is to categorize it as rock in the 191As, and then you can true up every 6 months or end of the year to recategorize that. So that's one of the reasons you'll see it a lot where 191As will show you return of capital. It gives you flexibility when you're trying to get to consistent income over that period of time to distribute in a way that's compliant and hopefully potentially as tax efficient as you can be.
Yeah, I mean, it's a complicated understanding rock. By the way, I hate the definition. Honestly, I think it's a big misservice and misleads a lot of people because the technical definition. I've addressed this in several videos. I've talked about it with pretty much all fund managers. People still think rock because they look at the definition. It's not their fault. I don't blame them. It's their own money coming back to them. But this is not the case here. You're not just returning people's capital. I tell people it has to do with taxes and accounting. ETFs that use options can turn the income into rock. It doesn't mean that it's all your money coming back to you. And what I like to always say is that total return is always the ultimate truth because total return, aka performance, that's net of fees and includes, it's net of everything. So the best gauge to know if an ETF is performing well or not, and it's very easy for a SPY or an S&P cover call ETF or Nasdaq 100 cover, just compare it to the SPY and see how it's doing. And this is what brings me to pretty much why I've been very excited and always keeping an eye on your ETF. The performance has been phenomenal. Now you've only been out 6 months, but if we actually do TSPY we'll do versus IVV, but SPY I'm assuming might even be a little bit better versus SPY because I think SPY is a tiny bit of a higher fee than IVV. You are currently outperforming the S&P 500. This is almost unheard of, by the way, with a covered call ETF. The only ones that are currently doing that on the US market are other zero DTE, daily covered call ETFs. In Canada, and this is just a side note in case you didn't know, the only ones that are beating, the only covered call ETFs that are beating the indexes, and I'm talking about like an S&P covered call ETF, the ones that use a little bit of leverage, 25%
Mm.
leverage. Unfortunately, no zero DT or daily option ETFs in Canada yet. I'm really trying to push hard for them to come. Maybe you could launch in Canada. That would be awesome. But anyway, you're beating the S&P 500 since the inception of your ETF. That's absolutely incredible, and not, by quite a large margin. I know it's only 6 months. Not only that, and by the way, if we just do the SPY, just in case people are curious, I'm assuming it would be, yeah, pretty much the same thing, approximately outperformance. And I'll also do it versus what I think is your top competition, the Roundhill ones. And XDT is their S&P 500 one, and you're actually outperforming them as well. So my question is to you is, how the hell are you doing it? And congratulations, by the way.
Thank you. It's the turtle strategy. The slow and steady wins the race. So one of the things that we do every day is we'll post our calls on our website, and you can always kind of see where we are. But our goal has kind of been a conservative to moderate call strategy. And so we're setting a lot of headroom between where the market is and where we set our calls every day, because our goal is we want to capture as much of the upside as possible. You can't predict it, but the trade-off is on a day-to-day basis, you take a little bit of a lower premium in order to trade for that headroom. And over time, when markets tend to go up, over time, that strategy ends up being a winning strategy versus if you're a lot more aggressive, you can get capped out, and that's when you start to trail the underlying. So we've been the turtle, the slow and steady wins the race. And over time, I think it's gonna pay dividends, no pun intended. But that's, I think, a big part of how we're doing what we're doing.
That's what I thought, but I wanted to hear you say it. You're basically writing more out of the money. You're
Exactly.
taking in less premium, but you're capturing more growth of the SPY. You're pretty much, and that's why it's in your ETF, income and growth, right? So that makes complete sense, and that's why your yield is up. It's still really high at 14 and a half, but it is lower than most other zero DT option ETFs, and it makes sense now. You're writing more out of the money. So obviously you're going to do better if the SPY rips up over time, which of course it does and probably will, with pockets of volatility, of course, once in a while. So, okay, that explains it. So yeah, congratulations on that. Now you
Thank
have,
you.
this is your only ETF. Are you going to be launching NASDAQ 100 and Russell 2000 versions of these zero DTEs?
Yeah, great question. So this is our first and only ETF right now. And we wanted to prove the model, especially, one of the other differentiators for us is we have an underlying technology that helps us kind of make those call decisions every day
Oh,
and
okay.
manage the fund. So we're proving out that technology, and what I love about ETFs is they're transparent, so you can see every day how it's performing. And as we're proving it out and we're seeing the demand come up, as soon as we hit 50 million in assets under management in TSPY, we're going to launch our second ETF, which is TDAC, the same exact strategy, but just on the Qs
Yeah.
instead of the S&P 500. So 50 million will be the marker, and that'll be the next one. And then from there, the Russell, that'll be sort of the third potential ETF downstream. But I'm an entrepreneur, and I get so excited, and I'm chasing all these butterflies. But I'm like, I've got to stay hyper focused and make sure we're proving the concept and doing really well with our first baby out of the gate. And then we can scale it from there once we prove the model and people have more and more confidence in what we're doing.
Well, it looks to me like it's working. It looks to me like you got a prodigy on your hands, my friend. Your first baby's a prodigy. So I wish you luck. I'm sure you'll get to 50 million eventually. People talk, this is it's a small but growing community, the income oriented or covered call ETF community, whatever you want to call it. I got some friends and fellow YouTubers on the US side as well. I'm sure we'll eventually start picking up on these. Normally, you hear super crazy high yield, so the ones that have a little bit of a lower yield take a back seat. But then, as word travels, I mean, the proof is in the pudding. You're outperforming the S&P. Hopefully that continues. We'll see what happens. I got a question for you. So in Canada, um, there's covered call ETFs. There's S&P 500 covered calls. There's covered calls on single stocks, a group of stocks. There's pretty much everything. It's actually the market kind of advanced a lot more than the US, but right now the US covered call market is exploding. There's a very particular type or design of fund that doesn't exist on the US yet, and I've been trying every US ETF fund manager been trying to convince them to do this. So in Canada, we have a lot of ETF, covered call ETFs that are leveraged 25%,
Hmm.
1.25x. This is classic leverage. It's not leverage using swaps or anything like that. They literally just borrow money,
Hmm.
increase, 25%. They borrow 25% of the fund. Interest rates are fairly low now, just to invest more. And the reasoning behind it is pretty genius. It's to offset the yield return trade off. Because when you write covered calls, you're cupping your upside. You add a little bit of that leverage, and now some of these have been out for over a year. And it looks like the leverage ones are either matching, more closely following the S&P 500, for example, or outperforming it. So why don't we have this in the US yet? And can you please launch a 25% leverage version of TSPY?
The short answer is yes, we can. And the interesting thing is, our trading sub advisor, who was the one that kind of took me under their wing to show me the ETF world. It's a organization called Tuttle Capital Management, and they're way edgier than we are. We're sort of
Is
like
that, sorry, did you
we're
say title?
Tuttle, Tuttle.
Okay, not title, Tuttle. Okay. Okay, sorry
Yeah.
about that.
Yeah. So Tuttle Cap, and they manage between 3 and 5 billion, but they understand leverage and actually how to implement it inside the constructs of an ETF. So one of the things that we could talk about is, our specialty is short dated covered calls. They understand leverage, and we work really closely together. And so that's a natural combination to find a leverage covered call solution, I think, in the long term. So those are definitely things from a roadmap perspective that we're interested in pursuing. Once we get TSPY to 50, once we get TDAC launched, then we'll figure out sort of the next piece of the product roadmap. But if this is working over the long term with non-levered fund, if you're a long-term buy and hold investor and you have a little bit of
Exactly.
leverage, then I think it makes all the sense in the world.
Of course, man, you're speaking my language, dude. We speaking. I mean, I could see eye to eye with you on what you're saying. It's exactly right. If you're just gonna hold a quality asset like an index fund forever, why not add a little bit of leverage? 25% is not that much. We're not talking about 100 or 200 or 300 like those 2x that reset daily. That's for traders. I am looking for a leverage product designed for investors, right? Because
Right.
I'm an investor, I'm not a trader. So I'm excited because it seems like you've thought about it and it could be a possibility coming up. But of course, you're waiting to hit that $50 million mark. So to my American viewers watching, I think this is very, very exciting time to be an American income investor because I mean, everyone knows what the S&P is, S&P 500. Now you have an income version where it looks like it's beating the S&P and you're getting a consistent 14.5% yield. It's absolutely incredible. So again, congratulations on this amazing ETF that you launched. I wish you all the best, all the success in the world, and I'll definitely have you back on the channel to see the progress of your company and whatnot. So unless there's anything else you would like to mention, I'm good for my question. So I'll leave you the last word.
No, I appreciate it. Really good to be on with you. And yeah, I think we definitely see eye to eye and have a similar philosophy, especially thinking for the long term and finding
Yeah,
that balance, I think is sort of where we found the sweet spot. And the whole idea, Tap Alpha, our company name, that kind of came from the idea of just tap into the potential of what you already have. I had the SPY shares, wanted to do a little more with it. It's the same idea when you actually do this whole philosophy for passive income investing. You can get more out of what you have. That's where the leverage fits in. That's where the covered calls fit in. That's where this whole providing access to that is sort of the ideal of what we want to deliver for the market.
yeah, with lower risk and volatility, right? Owning T-SPY is technically, it's not leveraged. It's technically less volatile, less risky than actually owning the SPY, right? Like any other covered call ETF. Would you agree with that statement?
Exactly. And in fact, like, so where we're getting some adoption to is wealth managers, so advisors. And they're like, wait a minute, you're getting market like and market beating returns, and your beta is a 0.83. Like, it's not one-to-one correlation. That's sort of the sweet spot of getting those outcomes, but a smoother ride.
To me, that's the holy grail of investing. If you could beat the index with less volatility, isn't that what all hedge funds have been created and designed for? So it looks like you've created that product. So again, congratulations. I'm very impressed. Hopefully that continues. I know it's been 6 months, but seems like you have a winning strategy. And hopefully, this zero DTE, the volume and the options keep growing and growing and growing, the popularity, which it seems like it is. But um, yeah, I could talk to you all day, but I know you're a busy guy and you already took the time. So I appreciate it. We'll have you back on soon. And thanks again.
Great to meet you. Thanks for having me.